All right. Well, good morning, everybody. And it's a wonderful day because it's finally sunny outside. We're expecting a little bit of heat today. So hopefully we'll be all in better spirits. It's tough to be, in the house all day long and you're looking outside. It's a little rainy, a little gloomy. So that's why we live in the desert, right? So we see sun every day. So today we're going to talk about the self-funded IRA. And I want to get into why it's such a remote and it is such a odd, exotic kind of asset class, or not asset class, but an idea. Why am I getting into this today? The number one reason is we are going into this recession, and after going through 5 of these things before, I can tell you that there are certain entities, institutions, and people that will come out of the woodwork during these kinds of times and start promoting things. And this is more of it's two-pronged today. One prong is how to protect yourself from these kind of promoters and things that seem so good to be true, but they're not. And then the second thing is I'm going to actually teach you a way to buy real estate, not inside of an IRA, but using an IRA as an alternative to getting cash flow out and actually taking money out to borrow against an IRA. Now, not technically an IRA, I'm going to show you how to convert it so that you can actually get a hold of a piece of real estate. All right, let's start off, and I'm going to talk really I have to always give some basics on what we're talking about today. So let me just flip over here, and I'm going to go through the actual text and go through it with you so you can understand it. All right. So basics. Well, we all know that under the new Secure Act, they have made a lot of changes. They've eliminated a lot of the rules. And one of those rules that they have brought in is that you can actually contribute past the age of 70. In the past, you used to have to stop at age 70. One of the other things that they changed was you used to have to take your required minimum distributions at age 70 and a half. Now that's increased to age 72. But one of the big negatives, and this will careen into what we're talking about today, is that beneficiaries must take their entire inheritance by the 10th year. There are no more RMDs to a beneficiary at death. It is simply you got to take 100% out by the 10th year. Now, if you add capital gain type of assets to an IRA, it is going to convert the tax to ordinary income tax. And what am I talking about? Well, in prior webinars that I've done, I talked about the disadvantage of putting an asset such as a stock, which is normally eligible for capital gains tax treatment, inside of an IRA. That stock is better suited on the outside of the IRA. And it's not much different than with a piece of real estate. Real estate is eligible for capital gains tax treatment. So we don't want to undermine that and increase the tax by putting it into a vehicle that is actually going to increase the tax. Now, what is an IRA best suited for? It's best suited for bonds and annuities which already have ordinary income tax put in. So here comes my big disclosure at what we're coming up to in this recession. So promoters, I think they look for these kinds of times to take advantage of people's fears. They take advantage of what they think people understand, which is people think that real estate is this almighty asset class that never drops. And so I can tell you from 1987 to the big crash in 99, to the yet bigger crash in 2001, to yet the real estate crash in 2006 and 8, as real estate is not a protected asset class. It is just one of the asset classes that needs to be in the portfolio. And as you've listened to me before, I've said, listen, you can either buy it individually, and there's some upsides to the individual side, or you can buy it through a REIT, a publicly listed REIT. Again, I am very, very adverse to any privately sold REITs. I have seen in 3.5 decades nothing but destruction. And it goes in these cycles. Real estate starts going up. The promoters, it used to be back prior to the 2006-8 crash. They used to be called 1031 TICs. That's TIC, tenants in common. And everybody was flocking to these things. And then the real estate market blew up. They all went out of business. And people lost almost everything that they had in these things. Some of them even took on additional liability. Then, obviously, the real estate market started going up again. Then you have all these privately sold REITs promoted by the financial advisors as being a protected asset class. Well, I do believe that real estate is, in fact, a good asset class to have. You have to decide whether you are going to buy it on the market through a publicly listed REIT, whether you're going to buy it individually, which comes with its own sets of headaches and risks. But I'm here today to tell you, do not buy into this whole idea that there are protected asset classes. The other asset class that I notice that always comes up in these kind of recessions is gold. So today we're going to talk about the self-directed IRA and the promoters that are promising that you can buy gold and you can buy real estate inside your IRA. And then finally, I'm going to give you some alternatives, some things actionable items that you can actually walk away from today's live stream and actually utilize your IRA better than what you might have utilized it before. So the promoters are promoting increases. I see the advertising increase. And you just look at, I just went online this morning. I just pulled some real simple advertisements off, and you can see protect your IRA, 401k with gold. How do you protect your IRA if you have gold and silver that has no income? It's an emotionally based class. And how to use your IRA to invest in real estate? Well, plan starting at $50. Let me tell you, it gets a lot more expensive than that if you're going to do it right. And now they're even promoting buying Bitcoin and all cryptos. Well, I will tell you that like in the 1849 gold rush, the people that made the most amount of money in the gold rush were not those people mining for gold. It was those people that were selling picks and shovels and wheelbarrows and panning accessories and clothing. And that's where Levi Strauss got their start. That's where they made their big money, selling Levi jeans. It wasn't from finding gold. So when these promoters are promising that you can buy gold and silver in the IRA, what do they get out of the deal? Well, you got to pay for storage. Who do you think is going to sell that storage to you? Of course they will. You got to pay for annual appraisal because RMDs and IRS reporting requires that you have an annual appraisal done. And then you have insurance. Well, insurance in case somebody steals it, it melts down in a fire. I don't know. Whatever could happen to that physical gold if it gets destroyed. Well, what about real estate in an IRA? Why do we put real estate outside of an IRA? Now, this is going to be very important because when we get into what happens in a self-directed IRA, it's important that you understand the others. So first, when we put a piece of real estate outside of an IRA, we can actually earn positive cash flow, but the depreciation deduction can wash out that taxable income. Also, when you sell real estate, there's many, many different benefits, such as we can exchange it for another property. It's eligible for capital gains tax treatment. And now under the Secure Act, where an IRA has to be taxable as ordinary income tax to the beneficiaries, well, if we leave a piece of real estate to somebody else while we're alive, all of that tax is forgiven. Now, if you leave an IRA to a beneficiary, again, it's all taxable income. Now let's talk about this big hook that people have. And the hook is, well, why don't I just buy an IRA, or why don't I buy one of these LLC IRAs? This is where the promoters will set up an LLC for you. The LLC is owned by the IRA. Now, again, a limited liability company. So think of it this way. If you have an IRA and you have $100,000 in your IRA, you can go buy Johnson & Johnson. That's a corporation. You can go buy Merck. That's a corporation. You can buy corporations with your IRA. You can also buy businesses, but there's a lot of limitations with this. And this is where the promoters don't always tell you everything. Now, on a side note, I do want to say something about when you read on these promotional sites. And again, I can't flash a bigger warning for you than this. When they say to you, these promoters, guaranteed, when they say approved by the IRS, when they say that they will back it up, how do they do that? See, I've seen the devastation that these promoters cause over the years, especially in recessions like this. When they say they're going to guarantee something, how do they guarantee that you're not going to be audited? How do they guarantee that? Because what I'm about to show you is the IRS tax code actually opposes the self-directed IRA with real estate and an LLC. So when they say IRS approved, ask them for IRS approval letter. They can't provide it. They're not even going to pay for the $7,000 to $10,000 to get maybe $20,000 to get a PLR, which is a private letter ruling. Now, if they can back it up and then they say, we will guarantee it for you, what is their means of guaranteeing it for you? I'm going to go back about 20 years in my practice. And at the time, I was practicing out of Sarasota, Florida. And there was a company there called Bracesoda Mortgage. Now, this mortgage company was taking people's money, and they were telling the investors that they were lending the money out. And they were lending it out to high-risk people. So you would give them, I don't know, $30,000. And at the time, they were paying 8 to 10% as a rate of return. Now, clients would come into me and they'd say, Ken, I know we have this moderate portfolio that you've designed for me, and it's only been making 7% rate of return per year. And why should I stick with that when I can go invest in this private mortgage, giving me 9 to 10% per year? And I would always go back to say, whatever seems fishy usually is. Now, the portfolio that we designed was in public companies. It was in corporate bonds and government bonds. These are things that are legitimate. These are things that are audited by the federal government. These aren't these little rinky-dink things that are telling you that they're going to pay you some unprecedented amount. And so what ended up happening was Bracesoda Mortgage was found to be fraudulent. And what they were doing is they were lending some of the money out. People were getting some of the returns. But mainly what they were doing is they were scraping off the top, kind of the Bernie Madoff kind of issue. And they folded because no pyramid could stand the test of time, and it is going to fold. And all these people lost their money. And we lost some clients at that time where they thought that they could have a better rate of return. And it was just devastating. I had people that were moving $2 million from us to Bracesoda Mortgage. And then after the receivers and after the feds got involved, they were coming back to us with $200,000 or $300,000 and saying, okay, I understand what you're saying now. Can you just please do the best you can with what we have left over? Again, you have to be careful when these people, because Bracesoda Mortgage put all these ads out, guaranteed 8 to 10% rate of return. They were running newspaper ads. They were running TV ads. And so when they see these things where they're saying IRS approved, ask for proof. That's what I ask. These promoters will contact us and say, we want you to promote this to your clients. I'll say, well, let's look at it. Give me the proof. Give me the IRS regulation. Give me the IRS PLR. So not that the PLR is applicable to everybody, but at least gives me some relevance that the IRS has reviewed this. And then I have to review the PLR to make sure that the case, that the private letter ruling that the IRS approved is exactly the same as what the promoters are actually saying is guaranteed or backed up. So I am very, very cautious about these deals where they come out and say, IRS approved, or I love the one ad I found this morning. Use the one IRS loophole. Well, I've learned it long enough that if there is a loophole and enough people use it, the IRS will close that loophole. I've just seen this over and over and over again, which is a lot of times why when we go down one tax pathway, if we see that the IRS is going the other way, we're going to change pathways. We're not going to cross hairs with the IRS on anything because it's too expensive to defend or to argue with the IRS. Now, if you have some very large deduction, then you might want to fight with the IRS and argue with them and prove your point. However, most of the time, people are arguing with the IRS over a couple $1,000 tax deduction, and it just doesn't pay for itself. So let's go back into the LLC and the checkbook, and we're going to talk about the prior strategy. The prior strategy years ago was you could go open up a self-directed IRA account with a third party, and you could go buy real estate, you'd have a third party that would handle all the checkbooks, the payments of expenses, handles the rent payments, etc. But now under the new strategy, people are promoting that you open an LLC and it's owned by the IRA. And then you can deposit, your IRA deposits funds in the LLC. Well, this is what they are saying is possible. You control the LLC, so you get a checkbook on the LLC. Well, let me just tell you, because it's on Google, does the IRS really, is it really approved by the IRS? And you can see I just pulled 3 ads from the Google, and you can see gives you control. Set up an account in minutes, makes it look really easy. Self-directed IRA custodian and solo investments checkbooks. Checkbook IRA for total tax-free investment control. Well, I'm here to tell you that's not how it really works. Here's what the IRS says in small print. You cannot be the key employee and key investor or own a controlling interest in that LLC. The duck test. You know what the duck test is? We commonly say this in the financial planning industry. If it walks like a duck, if it quacks like a duck, it is usually a duck. So who makes the decisions and who approves them? If you have an LLC and you're the one that is actually controlling that LLC, it is in your control. You are self-dealing. Records, even if you have a board of directors or you have an outside manager that is controlling that LLC, and a lot of times that's what these promoters will tell you. The promoters will say, so here's what we're going to do. We're going to appoint Billy Bob, your neighbor, and Jimmy John, your third cousin. And what's called the 672, section 672 related party section of the IRS tax code, you have to understand who is a related party and then also who has a controlling interest. So a related party might be a father, a mother, a son, a daughter, but a third cousin is not a related party. So what these LLC promoters say is, well, we're going to name these people as third parties so that you avoid the self-dealing interest. Well, here's the bottom line. You can name anybody that you want. That's not how it's going to work on an audit. If you get audited, what they're going to do is they're going to say, yeah, let me see your operating agreement to the LLC. But then what they're going to say is, let me see all the checks. Then what they're going to say is, okay, let me see where your managers approved you taking and writing that check prior to writing that check, right? Because apparently your IRA owns a company, and apparently that IRA that owns the company, that company has a bunch of managers. And that list of managers has to approve everything. And again, that cannot be you. So do not be led to believe that that can be you without any repercussions. So the C Corp proposal. So a lot of times what these promoters will say is, well, what you can do is you can use an LLC, you classify it as a C Corp, and then it'll avoid the rules. Well, the C Corp must have a separate board of directors. And again, you have to meet that section 672 of related parties, or not get related parties. And you also now have to meet your state's rules on quorum and voting, as well as a controlled board of directors. What are the costs of record keeping? You got to have annual meetings. The board of directors has to approve decisions, and the potential to break a rule and have the entire IRA disqualified and taxable. I don't know. I don't think that's really worth it. Promoters, as you just saw in the ads that I pulled off of the internet, the promoters use a rule from ERISA. Now, again, just because a promoter puts something on the internet and says, under ERISA rules, these things are allowed or not allowed. Well, do you really understand what that means? So many times people have come into our office after getting totally burned by one of these promoters. And I'll say, why did you make this decision? Well, look at this ad. Look what they promised. Look what they said. And just because it says, it avoids this ERISA rule, do you really understand what that really means? Promoters have this slimy way of saying things that seem like they're okay, and then when you do them later on, you think that's not what it applied to. But they're very crafty. They have good sets of lawyers that review to make sure that what they're putting out there in the cyberspace or public or advertising isn't going to violate any rules. But it doesn't mean that you are doing things right just because there's an ERISA rule that says that this is allowed. Let me explain what I mean. The ERISA rule that a lot of these advertisements refer to is the same act that removes IRAs from asset protection. When I talk about asset protection, you'll hear me say, if you have a ERISA-based retirement plan, that could be a 401k, that could be a profit-sharing plan, it could be a pension, an actual defined benefit pension plan. There are certain kinds of retirement plans that fall under ERISA rules. The IRS rules do not allow such unfettered control of a checkbook on the LLC. Remember, the LLC that these promoters are promising that you get this checkbook and you're going to write checks to whatever you want, however you want, that's a prohibited transaction. So here's the landmines. Not to just identify that the whole LLC idea inside of an IRA is really trying to walk across a minefield because it's so dangerous. But now let's talk about the other landmines about putting real estate into a IRA. So the first thing is called UBTI. This is an IRS rule that catches a lot of people. And what it is you're not allowed to have UBTI inside of an IRA. This is income derived from a trade or business. So as an example, you can't take your IRA and go invest and set up your own business. Now you could, but again, you'd have to do it in such a fashion where you have unrelated parties running, controlling, and making decisions on that business. Probably not a great idea. So is there an LLC renting property in a business? Yes. If you're going to buy rental property. So to form an LLC, it must have business purpose as well as an NAIC code. So it is a self-run business. That's different than a publicly listed company. Now, what happens if you get caught into UBTI is it's going to create tax on that income. And that's undermining the deferral of the IRA. It actually creates double taxation because you're going to pay tax on the income on the investment inside the IRA. And then when the IRA distributes the money back to you again, you're going to pay income tax yet again. Not exactly the preference inside of a tax deferred vehicle. Then the second landmine, UDFI. That's unrelated debt financing income. So let me give you an example. Let's say you have $100,000 in your IRA and it earns 6%. Let's say that you're just going to do this in a standard bond. But now what you do is you take the $100,000 that's in your IRA and you're going to leverage it up. What you're going to do is you're going to buy a $300,000 property and you're going to use it as a $100,000 down payment, but you're going to buy a $300,000 property. That property has remember the cap rate that we talked about in some of the other webinars. If you haven't, check out the other webinars that I did on how to analyze real estate as an investment. We talked about the cap rate. So if your cap rate is 6% or you're making $18,000 per year, the penalty that you pay is the difference. So you pay tax on that $12,000 of UDFI per year. So what is the alternative? So now we're going to get into a little bit of the concept on how you can take your IRA. You can still buy real estate with the IRA. Now, again, I would highly suggest don't fall in love with this novel idea and this popular belief that real estate is this lovely asset class. I'm here to tell you, it's not. It's hard work. There's a lot of risk. There's a lot of frustration. And you might be at a point in your life where you're sitting there going, I just don't like the volatility of the stock market. Well, let me just tell you, if I have a well-defined model, a stock bond model, and I've already measured out that volatility, I will take that volatility over dealing with renters, black mold, blown up HVACs, holes in the roof, city inspector. The reason that I don't have a lot of rental properties now is I don't like that. Now, I like the vacation play, which I talked about in the real estate webinar, which is, again, on both YouTube and Facebook. It's saved there, so you can go watch that. But if you ask me, do I want to go buy an apartment building? No. Been there, done that, don't like it. Now, some of you might be just a whole lot more patient than I am, and you don't mind dealing with all that. But it is a full-time business. So I'm not trying to promote this asset class of real estate as being this safe, wonderful vehicle. Now, if you're going to use this idea that I'm about to tell you to say, buy a house for a child, buy a house for maybe a sick parent or a parent that is that is having some financial trouble, great, you can do that. If you're going to use the strategy I'm about to give you to buy the vacation play property, great idea. The other two plays I talked about in the real estate was the long-term rental. You're going to be able to use this, but please go back and watch that How to Analyze Real Estate webinar, that live stream, before you just fall in love with that novel idea. You can use this for the flip play, but I'm not going to advocate that, because the flip play, again, is much riskier. And when you start including mortgages, and especially short-term mortgages on the flip play, in my opinion, that is way riskier than a stock bond portfolio. And if you ask me about gold, gold to me is one of the worst asset classes to invest in. Again, ask Warren Buffett. He's kind of the prophet of what everything that I have followed for 35 years. He doesn't invest in gold. Why? Because it has no income. It has no growth. It is emotionally based. And what we want to do with investments is when everyone else is ill-confident about what is going on in that market, but the asset class has to have earnings and growth potential. It cannot be based purely upon fear and greed. And what is gold based on? Fear and greed. It goes up when people are fearful, and when everything else is going great, it goes down. So where you see these commercials out there, well, I've made 85% on my gold in the last 5 years. Again, as I talk about this, tricksters can pick any date and time. So if I picked in gold, if I picked the lowest possible period of time where gold prices went, and I assume that it was bought at that time, I can then pick where it might be at the time of that advertisement. And yeah, you can come up with unbelievable rates of returns. But is it sustainable? And here's the other thing. What kind of income can you get if you're retired from gold? You have to physically sell it, right? And you know what happens? People buy gold, and you know what they do? They never sell it. They just sit there and hold it, which means it's a non-performing, non-life enhancing asset. So again, I am not a favorite of gold. Now, if you want to talk about gold stock, where there's actually earnings from minings and projected earnings, and I can look at a dividend, and I can look at a balance sheet and a debt to income ratio, and I can look at what the CEO is making, and I can look at PE ratios, that's a different story. Now, again, that's a risky asset class, and I'm not opposed to that. But buying the hard gold, and then worse, buying it inside of an IRA, absolute nonsense. Please do not do this. Gosh, this is such a, I had just had this, I don't know, what do you call it, epiphany. It's deja vu. This is me screaming at the top of my stump, no different than I did in 95, 96, and 97 about the tech market. This is me screaming at the top of my lungs in 2005 and 2006 about the real estate market. Look, I'm trying to teach people the things to do and the things not to do. The most disheartening thing that just goes to the depths, that hurts the depths of my soul, is when I preach these things and then people do just the opposite. And then they know that they made the mistake. They know they lost the money. And then they'll come back to me and they're devastated financially. And there's nothing that I can do about it. That is just, to me, it's like an overweight person going to see their doctor. They walk into the doctor, they're 100 pounds overweight, and they're smoking a cigarette, drinking a vodka. And the doctor sits there and says, you need to stop drinking, you need to lose some weight, you need to stop smoking. And the person goes, yeah, of course, of course I do. They walk out, they do the same darn thing. And that person dies. And then the family shows up and says, why didn't you help my husband or my wife? The doctor tried, but you got to have equal collaboration and participation. You got to listen to the advice. And as I keep saying, knowledge is not power. You can know about these things, but you also should get some objective, not advice where the person is going to benefit by selling you something. That's not advice. That's a sales pitch. That's why I have to hand it to every one of the financial planners that we have. They are objective. They don't sell products. They will tell you the things that you don't want to hear. They will argue with you if you try to propose something that is going to hurt you. They will tell you, they're not going to try to, make friends with you. They're going to tell you mathematically what is the right thing to do. And if that's something that you don't want to hear, then obviously you probably just want to go and invest however you want, watch Google or watch all of these advertisements, believe what they say. But unfortunately, because I've been through this, in 2, 3, 4 years from now, you'll probably be coming back and trying to find a fiduciary financial planner to help you. So please, please, please listen at this time. Please don't repeat what happened in 95 and 96 that happened in crash. Please don't repeat the same mistakes that happened in 2006, 2007. So let's talk about the alternatives if you want to go to the asset class. Let me flip back to that. Still getting used to this. Here we go. Okay, so we're back in the alternative. Create an LLC for rental property management. Now this, please understand, I am not suggesting that you create an LLC inside of the IRA. Let me be clear again. This is going to be in giant billboard fashion, flashing lights, neon. We're going to imprint this on our foreheads. We are not setting up an LLC inside of the IRA. We are setting up the LLC outside of the IRA. This is going to be an LLC that you personally own. It's going to own the properties, and you're going to manage the properties through this LLC. Again, let me state again, do not buy this inside of the IRA. You're going to open a profit sharing plan. Now, what is a profit sharing plan? Well, as we talked about before, a profit sharing plan is one of those ERISA-based plans. You have a 401k, you have a defined benefit pension, defined contribution. It's the same law that covers 401as, 401ks. There are these things that are covered under federal law. Keep in mind, an IRA standing for individual retirement account is not an ERISA-based plan. And therein lies the reason why if you're in a car accident and you get sued, they can take your IRA. However, if your money is inside of a ERISA-based and covered plan, it is protected from lawsuits. There's a big difference. So an ERISA-based plan can be a profit-sharing plan. Now, why do I suggest profit-sharing plans? Well, because you can set up what's called a simplified profit-sharing plan. Unlike some of the 401ks that you have to include safe harboring, there's a lot of rules. They're very expensive. My go-to has always been a profit-sharing plan because it's simple. However, getting back to those good old promoters, there are seminars, there are promoters that will either advertise on the internet, I see it on TV, and I personally know of some promoters that run seminars in Las Vegas and around the country, and they promote the buying of real estate. Okay, that's okay. And they promote the setting up of an LLC outside of your IRA. Yep, that's okay. However, they will sell you a profit-sharing plan, and they charge between $1,200 to $2,200 to create the legal document called a profit-sharing plan. Now, let me explain why that's ridiculous. So there are what's called IRS pre-approved profit-sharing prototypes. What does this mean? This means that a big brokerage company can create a profit-sharing plan, and they can submit it to the IRS for pre-approval. IRS says, all right, everything you've got in that plan is fine. You can then just get a normal account application, and you just check the boxes on what you want included and what you don't want included, and voila, you saved yourself a couple $1,000s from having to go to these legal firms, legal document preps, profit-sharing plan promoters to get a profit-sharing plan. Now, this is no different than an IRA. An IRA that you open through Schwab or TD or whoever else you open it through, that's a prototype plan. It's an IRA account that those companies have gotten pre-approved through those custodians. No different than a profit-sharing plan. Now, not all brokerage companies have a prototype plan. There are some big, even discount brokerage companies that will still charge you to get a profit-sharing plan. So again, if you're working with a fiduciary planner, they're going to know this. They're going to know what custodians offer it for free, and they're going to direct you there. And then they're going to know what custodians are going to try to charge you for it, and they're going to direct you away from there. So the goal is you create a profit-sharing plan. Now, as long as you include more than one person in that profit-sharing plan, it becomes ERISA-based. That's a wonderful thing because it gives us asset protection. It gives us a second item, which is it allows us to borrow money from the profit-sharing plan. Now, in normal times, when I say normal times, non-virus crisis times, you can borrow money from a profit-sharing plan. Again, keep in mind, I want to state this. You may not borrow any money from an IRA. Again, an IRA, you are not allowed to borrow money. Now, in a profit-sharing plan, you can normally take up to a $50,000 loan against your assets. Now, that's the max. Now, what if you only have $25,000 in your profit-sharing plan? It is the 50 grand or whatever the account value, 50% of the account value. So that means that if you have $100,000 in the account, you can borrow the $50,000. If you have $50,000, you can only borrow $25,000. Now, for a short period of time, the CARE Act, because of the virus crisis, you can double that. You can take twice as much of a loan. Now, what you can do is you can then take that loan and you can use that as an actual down payment for the real estate. What you do then is you borrow the balance for the purchase of the real estate. Then you're going to use an annual withdrawal from your profit sharing plan to cover any negative cash flow. Okay. Now let's go through the example of this. So you could take up to a $25,000 tax deduction personally every year. Again, that's based upon the income. Now, what I would suggest is, because I'm through this concept, is if you are interested in this, go back and watch that How to Analyze Real Estate and also the emergency actions to take on your real estate. Those are two additional videos. They're both in our YouTube channel, which is H&H Retirement Design and Management's channel. They're also on Facebook. Go back and watch those two videos. I explain who can and who cannot take deductions on rental property, because you might think, hey, I'm going to buy some rental property because I'm making $250,000 a year as a doctor. Well, sorry, you can't take a deduction on that. You exceed that income limitation. You can carry those deductions forward, but you may actually never end up using them. So be careful if you think that you're going to get into rental properties to get a deduction against your ordinary income. Now, on the other hand, you can, in fact, get a washout of the positive income. What I mean by that is, if you have positive income coming out of that real estate, doesn't mean that you're going to get a deduction against ordinary income. However, you can use the depreciation paper deduction, meaning when you deduct depreciation, it's not an actual expense against you. It's just a paper deduction, but you can use that paper deduction against hard cash income, so you don't have to pay tax on it. Now, when you sell the real estate, you can sell it and only recognize capital gains tax on the gain, not like the ordinary income tax that you might have to pay if that real estate is inside of the IRA. You can also, if you don't want to sell it outright, you can exchange the rental property for another property. So this is something that, we've been working on now for a little while, is if you have, let's say, a rental property and you don't want to be in the rental property business anymore, meaning you don't want that long-term tenant. You don't want to constantly be that receptacle to get a call at 11 o'clock at night. Hey, my toilet's jammed up, or hey, the light doesn't go on, or whatever it might be as a landlord, right? Because if you've ever been a landlord, that's fun. And here, you know what I'll do? Let me throw something in. Because I know a lot of people will come in, they'll say, well, I've got 3 rental properties and I've never had those kind of problems. I've got the best tenants in the world. Okay. So basically that is like having a corner store. And let's say that you buy a Reese's Peanut Butter Cup from your distributor for 50 cents. And the normal going rate of that Reese's Peanut Butter Cup is $1. And what you are trying to do is you're trying to compete to get people in your store, because you got to sell that Reese's Peanut Butter Cup for $1. And you're only going to pay 50 cents on it, so you know that you're going to make 50 cents. So what you do is you say, you know what? I know how I'm going to get all the people in the store. I'm just going to reduce the cost of my Reese's Peanut Butter Cup down to 60 cents. I know I'm paying 50 cents for it, but I'm going to reduce it down to 60 cents. So you're only making 10 cents. So what you're doing is you're working really hard and you're taking the risk, but you're not making any money. And people do this in rental properties. They'll say to me, I've had this tenant for 20 years and they never caused me a single problem. And then I'll look at the amount of rent that they're charging, and no wonder the renter doesn't move. They are so far under market rate. So then I'll look at the cap rate. And again, go back to that webinar that I did. It's in the YouTube and Facebook account. It's how to analyze real estate. I'll go back and look at the cap rate. I'll say, okay, you're charging this family, couple, renter, $1,000, but you could be getting $1,500 a month. So you're undercharging them by $500 a month. And so when I look at the cap rate and we analyze the real estate, that person's making 1 or 2%, but they're taking all the risk of the real estate. That doesn't make any sense. What I would rather do is have that person either up the rent to the renter, remove the renter, replace him with somebody that will pay the rent, or get out of the rental business. Because again, you don't want to own a corner store. You take all the risk and all the time, and you're selling all this product, and you're not making any money. Otherwise, you could sell the rental property. You could take the proceeds from it. You throw it in a 4 or 5% bond, for goodness sakes. You eliminate all of the risk that you might have taken for your tenant suing you, mold, HVAC, roof, repairs, location demise, all the risks that are in real estate. You get rid of that and you quadruple or 4x the amount of income that you're earning, your rate of return. So again, just to say I've got a renter and that renter's not causing me any problems, you got to look at what are you actually making on that renter. Now, in the perfect world, you would have a renter that's paying market rates. They're doing all their little minor repairs. If a light bulb goes out, they're repairing the light bulb. They're not bothering you. If they need to change an air filter, they change the air filter. But I have to tell you, out of 68 rental units, I had about 5 or 6 renters that were like that. The rest of them would call my crew up. I got a light bulb out. I need a filter replaced. Or, somebody broke the window. Happened to be their kids, but they would never admit that. So what do you got to do? You got to go out there and pay for a broken window. So in the idea of exchanging a rental property, a lot of times people get to the point where they just don't want to deal with the rental property. So instead of just selling it, you could sell it, you could pay the capital gains tax, but there is an alternative here. And you could basically just exchange it for another property. So what kind of property could you exchange it for where you don't have to deal with that? You could exchange it for the vacation play property. You could put it into a place that already has a proven property manager, a proven rental pool. You could put it into a place that maybe you hire a property manager to oversee it. That way you're not having to deal with all the issues that come up with renting. So you could exchange a rental property that avoids the tax under what's called the 1031 exchange. And you could also just leave the rental property to heirs. If you did that, 100% of all the tax is forgiven. So what I'm saying is you buy a $100,000 property, by the time that you pass away, if it's worth $1 million, when whoever inherits it, they inherit it at $1 million, zero tax, nothing. They get what's called a step up in basis. So now let's talk about how to use the IRA to actually wash out the tax, or to use real estate to wash out the tax. So what we're going to do is we're going to use an example of $1 million in an IRA. First step, we're going to move it to a profit sharing plan. Remember, we talked about that. We're going to simply open up an LLC. Once the LLC is open, we're going to establish a profit sharing plan. Once we establish the profit sharing plan, we're going to use a tax-free exchange. We're going to roll over the IRA. So you can roll one IRA to another, and as long as it's a direct transfer to trust to trust, meaning, hey, if I roll it from Schwab to TD Ameritrade or from TD Ameritrade to Schwab, and I don't touch the physical dollars, I can do that as many times as I want throughout a year. However, remember the rule is if you receive the physical cash, meaning you get a check, you can only do that once every 12 months, not calendar year, once every 12-month period. So there's a difference between a trust-to-trust transfer and what's called a 60-day rollover. So again, be careful because some of these promoters don't really, they don't explain this. We've had people come in and they'll say, well, I did this, this, and this, and I got to give them the bad news. The bad news is because the promoter didn't know what they were doing, you have to now pay tax on 100% of your IRA because you incorrectly did it. However, most people know you just move from one trust to another trust, and there's no tax on it. So again, what you're going to do is you're going to create your LLC. That is, again, let me state, not inside of your IRA. It's going to be owned by you. Once you create the LLC, you're going to establish a profit-sharing plan underneath the LLC. What do I mean? Well, if you have a company, you start ABC Widget Company, and you employ 5 people, and you decide that you're going to set up a retirement plan. So you own ABC Widget Company. ABC Widget Company is going to sponsor a retirement plan for your company. No different than this. You're going to establish the LLC, which you're establishing a rental property business. You're going to then create or sponsor a profit sharing plan underneath that company. So now you've got the profit sharing plan. Now you're going to roll your existing IRA into that profit sharing plan. So your IRA goes away. Now, let me tell you a little secret. Don't close your IRA. There are little IRS procedures that we will want you to keep that IRA open to move money back and forth, because certain rules apply to a profit sharing plan and certain rules apply to an IRA. Now, we don't want to keep any money in the IRA for a couple of reasons. One, there's no asset protection. Number 2, you can't borrow against it. However, because of these IRS rules, you want to keep it open so that sometimes you move money from your profit sharing plan, tax-free, back to the IRA to meet certain IRS rules and guidelines. Okay, mainly that has to do with required minimum distributions and even a charitable qualified charitable distribution as a QCD, which is way past the purview of today's discussion. We'll talk about that in another discussion, but keep the IRA open. Okay, don't close it. And you can link it if you're really good. You link it. So if you've got a whatever it is, Charles Schwab or TD Ameritrade profit sharing plan, keep that same IRA there and just create an account link so you can freely move money back and forth. There's no tax. Just create the link. It makes it easier when you have to perform certain duties. Okay, so anyway, let's go through a review. 1, you're going to open an LLC in your name, not in the IRA. 2, you're going to open a profit sharing plan. We're going to use a custodian that doesn't charge you anything at all. 3, you're going to roll your IRA into the profit sharing plan. 4, you're going to keep the IRA open and create some type of data link or account link to make it easy. Okay, that's it. Now what we're going to do is we're going to go ahead into the profit sharing plan and we're going to take a loan against the profit sharing plan. Now this is not a loan like you would normally think with a loan with the bank. This is a loan against yourself. So people will say, well, what's the loan interest? Well, here's a beautiful thing. Do you want more assets to be accumulated in your profit sharing plan? Probably not. But let's say you did. Let's say that you come in and our financial planners put together a plan and they determine that you're going to have what's called a cliff rate. What is a cliff rate? Well, normally what happens is people's income taxes go up. But you could have a situation where maybe you have this high income and all of a sudden it just drops off, and we can plan that out. And we can plan that you are going to be in a super low tax bracket. Well, then where do we want to divert money to? We want to grow that profit sharing plan. However, if we analyze and we feel that, hey, look, based on these calculations, you're going to have an increased tax bracket. What's the last place we want to put money? We do not want to put money into a profit sharing plan or into an IRA. Why? Contrary to what all the magazines and popular financial industry magazines say, you do not want a large amount in your retirement plan. Why? It's a terrible tax haven, right? Somebody says, well, it's a bomb shelter. Well, this bomb shelter's got a lot of holes in it, because if you are required to take out money and it stacks on top of your income, and then you pay an increased tax bracket, you lose benefits with Social Security, you pay a penalty on your Medicare, you lose itemized deductions, your family has to pay ordinary tax within 10 years. It's not so much a tax haven as it is a tax trap. So if your financial planner is projecting that you're going to increase your tax bracket, the last thing you want to do is accumulate more money in a retirement plan. I know that goes against everything you've ever read, but keep in mind, why am I telling you this? Our goal is to have the highest efficiency of money. How and why? Our firm makes more when you make more. So the difference is, if you go to a mutual fund company, you go to an investment management company, they're charging you a fee on just what you have. What we do is when we build a client's worth, we make more because they have more. And most firms don't consider taxation. So you have to consider what is the tax effect. So again, step 1, create an LLC. Step 2, create a profit sharing plan. Step 3, you're going to roll your IRA into the profit sharing plan. Step 4, you're going to keep your IRA open and link it. Step 5, now what you're going to do is you're going to borrow against your profit sharing plan, and you're going to set your own interest rate. The interest rate can be as minimal as what the prime is, or all the way up to 7 or 8%. Now, what does that mean? Well, if I borrow $50,000 from my profit sharing plan and I set my own loan interest rate at 7% and I pay that loan back over 5 years, the 7% that I'm paying back goes into my profit sharing plan. So if my intent is to build my profit sharing plan, I'm going to set that rate really high. If my intent is to not let that profit sharing plan grow, I'm going to set the interest rate as low as I possibly can. Now, going back to what's the next step after I do this? Well, now what I'm going to do is I'm going to go and I'm going to find a vacation property, well, rental property, whatever your play is. Let's say I'm going to make the assumption that I'm going to find a $600,000 vacation property, and I'm going to maybe partially rent it out throughout the year. Here's what I'm going to do is I'm going to borrow $50,000 from my profit sharing plan. I'm going to use that as the down payment. I'm going to have a remaining mortgage of $410,000, right? So what I'm going to, sorry, little typo there. I'm going to have a $450,000. Let me make that typo right here. Just notice that it's $450,000. I'm sorry. It is early morning. So I have a mortgage of $550,000. That is my typo right there. Yes, I'm owning that typo. $550,000. Okay, my estimated annual mortgage cost is going to be about $21,000 per year, assuming no rent and assuming that I am under the limit of $150,000 in adjusted gross income. I can take an annual tax deduction of $25,000. That my mortgage that I take out of my IRA is completely tax-free. Why? When I take the $21,000 out of the IRA, it's a reportable withdrawal. However, if I take a $25,000 deduction from my rental property, it's a tax deduction. So what I have is I have a zero cost on my withdrawal from my IRA. So this is a standard tax offset. So if you if you go to the website hhrdm.com, again it's hhrdm.com, there is a broadcast schedule there, and I've scheduled a tax in retirement webinar or live stream as per the case today. And in that class, I'm actually going to talk about the 4 tax strategies. Now, what was a benefit that I didn't realize was a benefit was when I got my first job as a financial planner, I had no idea what a general patent my first boss was going to be. You know, his name was Bill Moore, and hands down, without a doubt, he was one of the smartest people I've ever met in my entire life, and still stands true. The guy had an absolute photographic memory. And the scary part was you'd be walking down the hallway and he'd stop you and he'd quiz you. And he'd say, what is this section of this code? Or he'd say, how does this work? And, you know, he could memorize an entire tax code, which, you know, I applaud him on that, but I cannot memorize word for word an entire tax code. I remember conceptually so I can apply it, but I can't remember that. And so he was absolutely a general patent. And so the benefit of that was he did instill in all of us the 4 tenets of great tax planning. And here's what they are. The 4 tenets are: 1, deduct, defer, offset, shift. Deduct, defer, offset, and shift. So what I'm showing you right now is what's called an offset. When you look at something and you can say, if I maneuver that money out and I create a tax deduction, can I use it for something to get a tax offset? Now, is this the only offset? No. We can use what's called Section 42 low-income housing tax credits. We can use conservation easements. We can use a 664 trust, which, again, I'm going to cover all these things. Just go to that broadcast schedule. Today, I'm talking about one simple tax offset. That tax offset is using real estate to get money out of an IRA at little to no cost. Because, again, when we pull money out of an IRA, and I should probably make a clarification because I told you to move the IRA to the profit sharing plan, and I keep referring back to the IRA. I am technically at this point referring to your profit sharing plan. Now, before, I gave you a little secret that if you take a distribution prior to RMD age on a profit sharing plan, there is a rule that makes them withhold 20%. So you remember I told you you're going to create that IRA and you're going to link it to the profit sharing plan because there's certain rules that you have a better advantage if you take it from an IRA versus profit sharing plan. That's what you do. So if you're going to take this money out to pay the mortgage payment, all you're going to do is you're going to transfer the mortgage payment. You can do it online. And that's why I told you create a link between the profit sharing plan and the IRA. So if you've got $21,000 a year to mortgage payment, all you're going to do is you're going to go into the profit sharing plan. You're going to transfer $21,000 from the profit sharing plan to the IRA. This way, when you take it out, there's not a mandatory tax withholding as there is on a profit sharing plan. But again, there's benefits to the IRA, benefits to the profit sharing plan. That's why you keep them both open and you link them together. So the tax offset is when you take the money out of the IRA, it's going to be taxable. However, if I can take a $25,000 tax loss against ordinary income on the rental property, I've got an offset. Ready? I got $21,000 coming out of the IRA. That's a taxable event. And then I got a $25,000 tax loss on the rental property. That's going to wash it out. I mean, some people call this a tax wash, but in my training, it was always called the tax offset. Now, again, there's many different tax offsets. I'm just showing you one today. That's why I hope that you're going to join in on some of the other classes that I'm going to do. The conclusion, set up an asset protected LLC. Move the IRA to a profit sharing plan. You get asset protection and you get the ability to take a loan. Buy the real estate inside the LLC. If there is negative cash flow, withdraw from the IRA to cover the negative cash flow. Now, I'm not saying that you have to withdraw the $21,000. I was assuming in that example that you had zero rent. In zero rent, you're going to have negative cash flow. You're going to withdraw from the IRA. And is that better than a Roth conversion? I would tell you yes. Why? Because it's a tax offset. Remember, when you take money out of an IRA and convert it to a Roth, there's still tax due. It's at your bracket. This is a 100% tax wash or offset. So again, if there's negative cash flow, you're simply going to take it out of the IRA to cover the negative cash flow. And you retain all the personal tax benefits and you remove the audit risk from creating the self-directed IRA. Lastly, let me just wrap up. And for those of you that haven't taken advantage of the book, we have a few books left over from what the publisher sent us. So if you want a free copy of the book that I wrote back in 2016, Total Retirement Freedom, I talk about a lot of these tax concepts, a lot of these offset concepts in this. Just give our office a call or email Emma at admin@hhtba.net. And they will send a book out. No shipping, we'll cover that. The book is free, there's no strings. If you have a loved one, you have a friend, a neighbor, they would like a book, call us, email us, give us their information. We'll mail it out to them again, free of charge. There's no cost to it. All right, let me wrap up and tell you where we go from here. We are in this just horrible human tragedy that is happening around the world. And I'm not going to dismiss it, diminish it by any means. My job at this point, and the doctors, the politicians, their job is really to handle the human tragedy. My job is to make sure that each person that is going through this is going to survive and thrive financially. So my contribution to this is helping you through this to make sure that you have financial solidity, that you are going to be sustaining your lifestyle, that you aren't going to be making giant financial blunders and mistakes, because this is what happens. This is not my first rodeo. I see when tragedy happens around, and this will be the worst human tragedy of anything I've ever experienced. I mean, in 87, it was a stock market crash. In 99, it was a stock market crash. In 2001, it was a terrorist attack. But it didn't affect the entire world like this is going to affect us. So my goal with these is to try to help people as much as they can through this terrible, terrible time. And hopefully on the other end, what I'm teaching you is, hopefully what I'm teaching other people that you know, because I'm hoping that you share these with other people that you know, that you love, and that you want to have the same outcome as I want to have for you, is that at the end of this, when we get out of this, you're not in such a destitute place that your entire world changes. We saw this in 2008. People got financially destroyed, and the rest of their lives were completely different. So what I'm trying to do here is help, and how you can help is share it, pass it. There's no greater appreciation than I can see when I get all these emails afterwards and people are thanking me for it, but also they're asking me questions. That helps because, now again, let me throw a caveat in here. I can't answer specific questions. So I'm getting a lot of emails and a lot of questions. And they'll say, well, what do I do with this piece of real estate? We calculate everything. I can't just off the cuff say that this is what you do. I'm not these people on the TV saying, well, everybody should buy this stock and everybody should do this. It is individualized. So I appreciate the questions, and I love, and that helps me understand that this is making a difference. But you can make a difference. Share it. Tell other people about it. Let them not make the same mistakes that you might have made had you not watched and listened and learned some of these things that have happened in the past recessions and depressions. So with that in mind, I'm going to sign off. Have a great weekend, and I will catch back up with you next week.